Hi everyone and welcome to a brand new episode. My name is Marcus and I'll be your host. In today's episode, we're looking at Microsoft, ticker symbol MSFT. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. Should we be buying Microsoft? Well, let's find out. As I mentioned, we're going to take a look at Microsoft, ticker symbol MSFT. And they are traded on NASDAQ and are in the technology sector. If we go down to the screen, we can see that their market capitalization is $1.9 trillion and their revenue is $192.6 billion. The PE ratio coming in at 27.6. Now, guys, I like companies with a PE ratio of 20 or below. So having 27, that is just way too high for me. So that is a no. But at the same time, whenever you see a stock with a high PE ratio, that basically tells you that the market expectation of that stock is high, and therefore there are good chance that you might see capital gains on those stock. But on the other hand, whenever you see a stock with a low PE ratio, that tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks. Just keep that in mind. But having a PE ratio above 20, that is a no for me. Profit margin coming in at 37.6%. I like it because I like companies with a profit margin of 15% or higher. So coming in at 37, that is just way to go. I like it. So price to sales ratio is at 10. I like companies with a price to sales ratio of maximum 3. So coming in at 10, that is just too high for me. So that is a no. Price to book value at 11.6, that is just too high for me. I like companies with a price to book value of maximum 3. So this is just way too high for me. So if we were to summarize, PE ratio is too high, price to sales ratio is too high, and price to book value also is too high. This tells me that Microsoft at its current state is overvalued, so that is a no. But at the same time, they do pay a dividend of $2.42. I like it, so that is a go because I like those recurring income. And effective return at 0.9, that is way too low for me, so that is a no. I would like to see a range between 3 to 6%. That would be acceptable number. So 0.9, that's just too low for me. But at the same time, guys, I don't want you to jump the gun just because you see a stock with a high effective return, because that could be a trap. I want you guys to look at the overall history of this company. How is the stock price performing? Because whenever you see a stock with a high effective return, sure, whenever you buy, you get a good return on your investment. But at the same time, look, is the price consolidating? Is it moving within a negative trend channel? How is your exit strategy? Because the risk is that when it comes time for you to exit the stock, you might not get a higher price than what you bought it for. Just so be aware of that. So return on equity coming in at 48.7%. I like it. Basically, what it's telling us is that return on equity tells us about the company's ability to create return on their equity, meaning their ability to create return on the capital you're about to invest in them. So make sure you have a company with a good and strong return on equity. So 48.7, I like it. So that is a go. Return on assets coming in at 15.7%. I like it, so that is a go for me. So the stock is currently traded at $256 per share, and if we go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. This indicator is telling us that we might see the stock price decline. If we take a quick glance on the chart, we can see that we have been for quite some time moving within a positive trend channel, but as of lately seen lower levels. So right now we are in a negative trend channel, but we'll take a closer look at the technical aspect of the stock further down. But let's head over to the income statement, and what we can see here is that the total revenue went from $96.6 billion up to $165.9 billion, and these numbers have been improving every year. I like it. Gross profit went from $62.3 billion up to $115.9 billion. Same thing here. These numbers have been improving every year. I like it. Net income went from $25.5 billion up to $61.3 billion, and these numbers have been also improving every year. I like it. I'm liking what I'm seeing right now. Now let's head over to the balance sheet, and what we are interested here is that the current assets versus the current liabilities, and we can see there is a huge difference between the current assets and the current liabilities. So that is a plus. Basically, what is happening here is that if the company were to convert their current assets to cash, they're able to pay off their current liabilities, and that is amazing. And they're not far from being able to pay off their total liabilities, which is negative. But if we look at the total liabilities, we can see that it has been moving from $162.6 billion up to 191.8, and these numbers have been growing. They reduced it a bit in 2020, but overall trend is negative. The debt is growing, so that is negative. I would like to see them start reducing the total liabilities and also reduce the rate which the liabilities are moving, so that is negative. If we head over to the outstanding shares, we can see it went from 7.7 billion shares down to 7.5 billion shares, and these numbers have been decreasing over the past 5 years, so that is a plus. So what does this tells us? Well, whenever you see these numbers decrease, that means that the company is doing buybacks, meaning that there are fewer and fewer outstanding shares out there, making your share of the company grow. If we were to see these numbers increase, that would mean that the company is issuing more and more shares, meaning that there are more shares available, making your share of the company decrease, meaning that you're being diluted as investor. So be very cautious here. Don't just jump the gun because you see a company with a strong balance sheet. They may have a lot of assets and the debt's not growing that much. But on the other hand, we might see the company issuing more shares, because that's a way for a company to bring in more capital without taking on more debt. So be aware of that. Now, let's head over to the cash flow. And what we're interested here is that the operating cash flow versus the capital expenditure. And we can see the operating cash flow came in at $76.7 billion and the capital expenditure at $20.6 billion, making a difference of $56.1 billion, and that is just amazing. We can also see that the operating cash flow came in at 39.5 and grew to 76.7, and these numbers have been improving every year. That is amazing. And the capital expenditure went from $8.1 billion up to 20.6, and these numbers have also been improving every year. I like it. Basically, what is happening here is that the business is doing better and better, and also that they continue to invest in their business. That is just great. I like that. Now, let's head over to key figures. And what we can see here is that the earnings per share went from $3.31 up to $8 per share. And these numbers have been, we fell off in 2018, but have since seen better and better numbers. That is a plus. Revenue per share went from $12.5 per share up to $22 per share. And these numbers have been improving every year. That is a plus. Equity per share went from 11.3 up to 18.8. And we fell off a bit in 2018, but overall trend has been positive. I like that. Dividend per share went from $1.5 per share up to $2.20, and these numbers have been improving every year. I like it because I like the fact that I like recurrent income, but also that the income is growing every year. That is amazing. I like that. Dividend share, a bit of fluctuation here. We see 46, 76, 35, 34, 26. I like it. Why? Because I like company that pays out less than 60%, because I want some of the capital to remain in the business for investments, for acquisition, and just overall strengthening the financials in the business. So seeing that they are below 60%, that is a plus. I like it. Gross margin went from 64.5 up to 69.8%, and these numbers have been improving. Fell off a bit in 2019, but overall trend has been positive. So what does this tell us? Well, it tells us that the company is becoming more and more efficient. So that is a plus. But at the same time, we need to compare these numbers across the industry and see how is Microsoft doing compared to the competitors. But seeing that these numbers is improving, that is amazing. Operating margin went from 30.9% up to 42.8%, and we fell off a bit. We grew, and these numbers have been improving every year, so that is a plus. Profit margin went from 26.3% up to 36.9%. We fell off a bit in 2018, but have since and fell off again in 2020, but overall trend is positive. I like that. Return on equity, as I mentioned, tells you about a company's ability to create return on their equity. It went from 29% up to 43%, fell off in 2018 and 2020, but overall trend has been positive. That is amazing. I like that. Return on assets went from 10% up to 18.3%. Fell off a bit in 2018, but have since seen better and better numbers. So that is a plus. Solidity. Well, solidity tells us about a company's financial strength for the long term, and we can see that it went from 35% up to 42.5%, and we fell off a bit in 2018, but have since seen better and better numbers. So that is a plus. Balance sheet liquidity went from 1.3 up to 1.7, and we can see that these numbers have been improving every year. That is a plus. Balance sheet liquidity basically tells you about a company's financial strength for the short term. So and we're seeing that they are doing better and better. Debt ratio went from 1.8% down to 1.3, and these numbers it grew in 2018, but have since seen lower and lower numbers. So that is a plus. Basically, what is happening here is that the debt ratio is decreasing, meaning that in 2021 they had a debt ratio of 1.35, meaning that they had 1.35 times more debt than equity, and seeing that these numbers is decreasing. That is just amazing. So guys, we have gone through the income statement, balance sheet, cash flow, our key figures. Now over to our key feature, which is our stock analyzer. Basically what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If we look at the screen, we can see that the PE ratio is above 20. That is negative. They pay out a dividend, which is a plus. The dividend payout share is below 60%. That is a plus. Dividend increased over the past 5 years. That is a plus. Numbers of outstanding shares have decreased over the past 5 years. That is a plus. Revenue increased over the past 5 years. That is a plus. Profit margin above 15% plus. Profit increased over the past 5 years. That is a plus. Current assets is greater than current liabilities. That is a plus. Solidity increased over the past 5 years. That is a plus. And balance sheet liquidity increased over the past 5 years. That is a plus. And debt equity ratio decreased over the past 5 years. That is a plus. But the total liabilities have grown over the past 5 years, and that is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers, or have the software do the heavy lifting for you. And you can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comments.sc and become a member today. Okay, thank you. Now let's take a look at the technical aspect of the stock. So here we have the chart. As you guys can tell, we have been moving within a positive trend channel for quite some time, but as of lately seen that the stock price, it has been decreasing and is now moving within a negative trend channel. Now we don't know how long this trend will be, but we know this is not unique for Microsoft. This is across the board. All industries and all businesses are being affected with it. We are moving within a negative recession, and we are seeing that the interest rates are growing. So therefore, a lot of people are moving their capital outside from the stock market. So if you're a long-term investor like me, you're not worried about this. What I'm more interested in is seeing that this number continue to fall in order to give me an opportunity to buy and have a better effective, better returns on my investment. Overall, I'm not worried about Microsoft. The numbers are looking good. It's a large and stable company that will be around for many years. So for me, what I'm seeing here is just buying opportunity. I'll continue to add Microsoft to my portfolio because it's such a great company and it'll be here for many years to come. So I'm positive about Microsoft. I'm not worried about seeing that these numbers are decreasing. That only provides me with a buying opportunity. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment sections below. If you have any questions, just let me know. I'll be there to chat with you guys. If you have stocks you want me to take a look at, let me know and I'll do a video about that. Thank you guys so much for watching. I hope you have enjoyed this episode, and please give me a thumbs up, comment, subscribe, and until next time guys, take care. Bye bye.